Good evening, everyone. Welcome to the next webinar of Sovafair. And this time we have got a different kind of a topic. Maybe you can call it as the tomorrow's topic. It is the topic which is primarily on environment, society, and governance, ESG. So when organizations start focusing only on the top line and the bottom line, at times they conveniently forget about the fact that there is something called as a planet we live in, and there's something called as society we have to take care of. So then somewhere in late 90s, it started gaining a credence, and then in late 2000s, first decade, it started gaining more acceptance is the concept of triple bottom line. Triple bottom line meaning people, planet, and profit. All three has to be looked at carefully. All has to be taken care of. So if you look at power plants being put up or any of the agitations happening, they all focus fundamentally on the planet and people aspect. So in that context, we thought it may be appropriate to have a topic like this, which in this current context of where most of us are sitting and thinking about our own life as to what we have done and what we intend to do next with almost 75 days of lockdown now. It makes a lot of sense to think through and say that what is going to happen tomorrow as well in the context of the kind of business scenarios. So therefore, we thought we will have that environmental, social governance in the new age organization as a topic for this week's webinar. So we'll be having a presentation followed by Q&A, the usual format what we have. But this time we have got somebody who is an expert from outside our company who has got a rich experience in this domain. I'm so happy to present to you Mr. Ramnath Iyer. He's the ex-managing director and head of data management at MSCA. He worked in CRISIL in a very senior position, 25 plus years of experience. I know that it is 25 plus years of experience because he was my student 25 years back. He was my first set of guinea pigs, in fact. So he led operations and technology across businesses. Wide experience in real estate, equity benchmarking, ESG ratings and credit ratings and corporate research and advisory. So very quickly before I hand over the screen to Ramnath, quick protocols. Please keep your audio muted. For the full screen view, click the three dots at the right bottom and change the layout and choose the spotlight for what you want to see. Keep typing your questions in the chat box. We'll consolidate and ask the questions to Mr. Ramnath at the end. Final Q&A will be for 15 minutes. So Ramnath, you can take around 45 minutes to 50 minutes. Then we can have the Q&A. So Ramnath, I'm closing the screen now. You can start presenting now.
Thank you, sir. Let me try and bring up my screen. Hold on. Professor Hariharan gave a very eloquent introduction. Now let me put some of the points he made in perspective. Today morning's news item was that CDP has suddenly started asking questions to 37 Indian large corporates about their environment and social impact. They've been telling these corporates that combined their impact may be as much as 4,000 metric tons of carbon emission in a year. Now I'll put it in perspective. So what CDP is saying is that these corporates may be polluting as much as US was polluting the entire world in 2017. $70 trillion is today's total asset under management. And of this $70 trillion, nearly 18 trillion is invested in organizations that are socially, environmentally responsible and have high governance standards. So what is this webinar going to talk about? So what we are going to look at today are really 5 large buckets or areas that will give us a good overview on what is ESG. What are the obligations that most corporates have under ESG? And what are the community expectations? Now we're going to cover both, because a corporate obligation may be from a profit perspective what is important. The community perspective supersedes what the corporate expects. And we know there are a number of cases where the community or the society has penalized corporates that have not been good ESG citizens. The third area that we will touch on is the legislation on ESG and whether the comprehensive, first, do we have comprehensive legislation on ESG? And second, have the legislations by themselves ensured good corporate behavior? Then we will look at the mistakes that we have seen in the recent memory. And more important than looking at the mistakes is look at the cost of making the mistakes. And finally, we will look at what organizations are doing. Why did the mention of Professor Hariharan go towards what will the future look like in terms of ESG and the criticality of good ESG practices. So let's start, as I said, with the community perspective. I don't want to get into the organization perspective before we look at what does the community want in terms of a responsible organization. Now, the general definition of ESG is that ESG stands for environment, social, and governance, the three key factors that measure sustainability and ethical investment in business or a company. So the key operating sentence here is measurement of sustainability and ethical impact whenever business gets an investment. So the impact on the society and the environment when business makes investments. So that's the operating phrase. What does UN Nations Global Compact say? Now, how do we look at society? Society is obviously 7.2 billion people that we are in the world. But society itself doesn't have an opinion. So society forms collective bodies and collective bodies have an opinion. And what is UN Global Compact? UN Global Compact is a non-binding compact where 13,000 global corporations have signed up across 170 countries. And there are 10 principles that UN Global Compact has set out. And what it says in terms of a summary of those 10 principles are: corporate sustainability is all about the company's value systems, responsibilities, and the areas of responsibilities include human rights, labor, environment, and anti-corruption. So this is what UN Global Compact has to say about ESG. And then let us finally look at the investor perspective in terms of the community. So the large amount of ESG changes are being driven by investor demand. And as I said, $70 trillion is the total asset under management globally, of which today 26% is going towards organizations that are socially and environmentally responsible. And UNPRI is the central body that defines what are the principles for responsible investment. And what they say is that for responsible investment, the funds have to explicitly and implicitly and systematically include ESG issues in the investment analysis. All material factors on E, S, and G need to figure in the investment making decisions. So in summary, what we are saying in this slide is that the community is saying that organizations need to be responsible environmentally, socially, and that responsibility has to be implemented with a good governance. 13,000 corporates have signed the UN Nations Global Compact. And what they are saying is that their responsibilities will be in the areas of human rights, labor, environment, and anti-corruption. And bulk of the investment today is going towards organizations that are responsible on ESG. And as we speak, the number is 26% of the total investment globally has gone towards responsible companies. What are the organizations' understanding of ESG? Now, this slide is talking of scope and benefits, but let's look at the benefits before we look at the scope. And why do we have to look at the benefits first from the organization perspective? Because the organization is not going to invest a single dollar unless they see that there is a reward of making that dollar of investment. So what are the organizations saying? And what is this slide talking about in terms of organization perspective? So first, before I get into the slide, I need to give you an overview of what does the global environment impact just in terms of greenhouse gases look like. The environment impact itself is not quantified, but one of the most favorite topics that everybody has on mind is the carbon emission and the global warming by virtue of carbon emissions. So just to put things in perspective, 46 gigatons of emissions is what we have today in terms of greenhouse gases. Of these 46 gigatons of greenhouse gas emissions, 13 gigatons come from one single country called China. Yeah, US is half of that at about 6, and India is half of US at about 3. So just these three countries put together will contribute nearly 40% of the global emissions. So to make a meaningful impact globally, unless these large countries in terms of greenhouse gas emissions change their perspective on ESG, nothing material is going to happen across the world. So with this as the perspective, what KPMG China did under the aegis of the chartered secretaries and a couple of other bodies was survey 212 business leaders across China and Hong Kong to understand what do they get from the ESG mandate. Do they get what ESG means? Do they see benefits of ESG? And what are the kind of investments they're making in ESG? And as I said, unless China, US and India change, globally, the material impact of ESG will be minimal. So on surveying these 212 business leaders, what came out is very interesting. So the first thing that came out was majority of the leaders surveyed agreed that ESG was critical or good for the business. 46% said that ESG will directly lead to higher value of the organization. 37% unfortunately said, or rather 63% unfortunately said that they get the importance of ESG, but they have not integrated ESG into their strategic planning or everyday activities. In terms of investments, these organizations recognize that they have to change the paradigm in the future. And what these same executives said was, every dollar of investment that they will make will go into one of these three large areas. One is, how do their organizations perform in terms of tracking and reporting ESG related issues? What are the risk management systems looking like in the future? And where are the opportunities to improve ESG compliance? And what is the governance structure in place to ensure that all future investments are ESG compliant? In terms of the survey, they also inquired on what are the kind of issues that are likely to affect businesses in the next 3 years. So 58% said it will be environment regulations, 33% said climate change, and 33% said customer preference towards more responsible products. So what we are seeing here is, if you actually talk to executives in the part of the world that contributes most to the greenhouse gases, there is a growing realization that unless there is an ESG focus that the organization demonstrates, the value will not grow. The value provided by the organization will not grow. They are also recognizing that they have not adequately invested in ESG, and they know that in the future, environment, social and governance issue is going to largely shape the way the customer prefers their products and the way investors select their organizations for investment. there benefits? So now the executives are getting the benefits of staying or focusing on ESG. But what are the real benefits that organizations get by investing in ESG? So the first is revenue growth. Why revenue growth? For two major reasons. One, organizations that are using resources sustainably have greater access to raw materials or resources. If there are two organizations competing for the same resource, governments are likely to award the resource use to the organization that is going to demonstrate sustainable resource use rather than an organization that does not have sustainable practices. So access to resources is better with organizations that are environmentally and socially responsible. Second, customers have already shown a preference, all things being equal, to buy products that have smaller environment footprint and are more responsible socially. In terms of cost reduction, we have seen direct benefits from ESG adoption. Just two of the most obvious are lower energy cost by shifting to renewables and fewer remediation costs. What does this mean? We will look at it in greater detail later, but just to summarize, fewer remediation means less problems that you have to fix because you had environmental issues like the Volkswagen emission. Productivity, the more socially you are responsible, the greater your engagement with employees and greater the productivity of the social ecosystem that works with your organization. And finally, asset optimization. What do we mean by asset optimization? Usually investments have a shelf life. When investments are environmentally conscious or investments have taken the environmental impact into perspective or consideration, the investments will last over a longer duration. Why? Because new environmental or social regulations will not require you to retrofit, let's say, high emission power plants, or it will not require you to retrofit your shipping lines to reduce the carbon footprint and so on. So investments typically have a longer shelf life. Are the executives that are making decisions on investment getting this? Again, the KPMG survey says yes. A large number of corporate surveyed say that they understand ESG investment will improve reputation and brand image. They understand that it will reduce waste and costs due to improved operational efficiency. It leads to competitive advantage, provides growth and innovation, and you will see a surprising 27% of the executives understand the sustainability and index rating. And we will see what sustainability and index rating means later in the presentation. Is something that will improve with an ESG focus. And what does that mean? It means that they have easier access to capital. So if that is the case, how does business see ESG? First, we saw that business leaders understand that ESG is critical. They also understand that there are benefits of espousing ESG. So what, according to them, is the scope of ESG? Most executives understand that use of natural resources, operations impact on environment, and management of climate risk is what comes under the environment part of ESG. For the social part of ESG, they understand that their impact on direct and indirect employees, supply chain, customers, and communities is what the social part means. Now here it is important to spend 30 seconds understanding what is the impact on supply chain. All of you would have heard not so long ago about the suicide cases that Foxconn had, where a lot of employees in Foxconn were actually taking their own life due to work stress. Now, while this was an issue with Foxconn, the company that got impacted was not really Foxconn, it was Apple. So on all other areas, Apple had a stellar track record in terms of its social impact. But when it came to the supply chain, unfortunately, due to the Foxconn work stress levels, Apple's reputation was tarnished. Customer and communities, we have specific examples that we can look at later. In terms of governance, there is a structure and independence of the company board, executive compensation, and strategic alignment with shareholder objectives. Just one sentence on what is the strategic alignment with shareholder objective. Shareholder obviously invests in an organization for long-term capital appreciation. Unfortunately, most executives get compensated based on quarterly performance. So we can see the disconnect. Shareholders want long-term returns. Executives are compensated based on short-term quarterly revenue numbers and profitability. If there is no alignment between executive compensation and shareholder objectives, we will see a number of scandals that we have already seen in corporate and the impact the shareholder objectives. The last slide, looking at the scope and benefits, is the business perspective. After understanding what is the scope and that there are benefits, what are businesses doing in terms of adopting ESG? Again, let's go back to the same survey. We have some 20 odd studies that are just 2019 in vintage. But this specific one, as I said, is most relevant because it comes from the part of the world that makes the maximum impact in terms of ESG. And what the executives there are saying is that they are already adopting ESG in their development of policies. They are consciously bringing up ESG as a discussion area in their boardrooms. They have set performance indicators to track ESG performance, and a meager 37%. It's not an encouragingly large number, but it nevertheless is a start, have already integrated into strategic planning. They're also recognizing that ESG is going to make a big impact on the triple bottom line that Professor Hariharan talked about. And that impact is going to come from the environmental regulations. So increasingly, we will see more aggressive environmental regulation. We will see more focus on climate change and carbon related issues. Changing customer preference towards more responsible products and services. Why is this? When I was under the tutelage of Professor Hariharan, we used to hear that the largest market cap was by automobile companies called Ford and GM, who unfortunately a few years ago filed for bankruptcy. Today, the largest market cap in automobile is Toyota. But a couple of years down the line, everybody knows that the largest market cap is going to be Tesla. So if that does not signal the change in customer preference toward more responsible products, we will not get a better example. So what we have looked at in the first set of slides is that there are society has come together in the form of UN and has articulated its expectation. More than 13,000 corporates have signed up and said, yes, we will meet the society expectations in terms of ESG. To ensure that organizations that are socially and environmentally responsible get more investments, UNPRI is a global body which has come out with a set of standards and disclosures. And almost 26% of all investments globally today are going towards environmentally and socially responsible companies. Executives in large corporates get that. They know what are the benefits of ESG compliance. However, 67% of them or 63% of them have not integrated ESG into strategic planning. But at the same time, they understand over the next 5 years, because of more stringent regulations, customer preference changes, and more demands on managing climate change, their organizations will have to alter their business objectives. Let's go to the second section of the presentation now and see what does the government or regulator ask companies to do on the area of ESG. So let's start with the environment. and let's look at India because it is more relevant for this webinar. Now, if I just cull out the headline regulations on environment, we have more than 11 laws that every organization has to comply with while doing business in India. These laws protect the environment, they protect the air quality, they protect the water, they regulate the hazardous waste that can be released in the environment, they protect the wildlife, the forest, the biological diversity, the coast, the plant varieties, animals, and if that is not enough, there is also a tribunal act that ensures that in case there are environmental disputes, it doesn't have to go to the courts. It can directly go to the Green Tribunal and get addressed before the environmental damage goes out of hand. So what we are seeing in this slide is that the government, by virtue of these laws, is already asking the organizations to be environmentally responsible. They are not stopping with the environment. They have gone ahead and said that you have obligations to the society also. And the same regulators, and I'm just giving the example of India, are asking organizations to be socially responsible. So what India has done is they have ratified the ILO conventions and they have adopted 39 of the charters. So any organization doing business in India has to conform to the ILO conventions, and 39 of the charters have to be adopted. The government protects trade unions. So what they are saying is that workers can form their own unions and they can have collective negotiation with businesses. Government stipulates minimum wages, it has an industrial dispute act, it protects contract labor, it protects women employees through a maternity benefit, it has equal opportunities, there is a state employee insurance act, there is a payment of gratuity and provident fund act, there is an equal remuneration act that ensures that there is no gender bias. It protects construction workers, it prevents child labor, it prevents harassment of women at workplace. There is Information Technology Act that ensures that there is data privacy. There is Factory Act and Mines Act. There is a Consumer Protection Act and the Competition Act. These 16 are only, again, the headline regulation. If I actually start listing down, there will be more than 40 in number. So governments have recognized the social impact of businesses and they have said, yes, there are a number of compliances that organizations have to meet in terms of society. Finally, in terms of governance, again, the government is saying that organizations have a responsible governance framework in place. And the Companies Act, which is the umbrella legislation, talks about how the board has to be constituted, the committees that every organization needs to have and their powers, the shareholder rights, the annual and event-based disclosures, audit and financial statements that companies have to publish, prosecution in case the legislations are not complied with in letter and spirit. There is SEBI that also talks about listing obligations and disclosure requirements of large corporates, taking over of small corporates or other companies by businesses, disclosure in terms of issue of capital, related party transactions, prohibition of insider trading, director and employee compensation, whistleblower in case there are practices that are nefarious and what protection whistleblowers get, bankruptcy code on how can you or what you need to do in terms of ensuring that your investments or the shareholder investments in your businesses are sustainable and protected, and finally the Prevention of Money Laundering Act. So what we are looking at section 2 is that regulators, and I've just taken the India example, globally regulators have been quite proactive in listing the requirements that organizations have in terms of protecting the environment, fulfilling their obligations to society, and ensuring that their investors have adequate safeguard. Now, has this worked? Now, what we will look at in the next section is some examples, both globally and in India, to evaluate if all the regulation that we have had on ESG has really made the impact. And why are we talking about ESG today, when some of the legislations that we've looked at go as far back as 1926, even before India was independent? The short answer seems to be, we have laws and regulations, but our compliances, and not just India, right? Globally, the compliance seems to be inadequate. Let's take some large examples and see what is the kind of impact due to inadequate compliance. Let's start with Fortune 500 companies, right? So let's start with British Petroleum. In 2010, BP had a gas leak called the Deepwater Horizon leak. It was in the coast of US. 4.9 million barrels of oil were spilled into the ocean. And the cost of remediation of the oil spill was to BP $65 billion. Here I'm not even talking of the environment impact of the oil spill. I'm just talking of the financial impact that BP had to carry because of that oil spill. More recently, we had the nuclear disaster in Fukushima, Japan, which was the second most severe nuclear accident since Chernobyl. And the cleanup of that disaster is going to take anywhere between 30 and 40 years. What is surprising in both of this? In BP, there were a number of safety reports that said that the safety mechanism in the oil rig is not adequate to prevent oil spills. And in Fukushima, interestingly, the structures were designed to handle waves that would go up to 6.2 meters, while the region had tsunami waves that had hit Fukushima, and the waves were more than 10 meters in height. So the inability of Fukushima to withstand a tsunami was well known before this disaster happened. Let's then look at Volkswagen, right? So this is one of the most recent in memory. The organization Fit Defeat Devices, we know that diesel cars created unquantified damage to the environment. And the impact to Volkswagen as of Jan 2020 from this scandal is $35 billion. And I'm not quantifying the environmental impact that we had globally because of the Dieselgate scandal. This is just the environmental impact that we can remember quite distinctly by large companies. Socially, there are 3 or 4 areas. We are all aware of the Harvey Weinstein case, where there was harassment and we had the Me Too movement. We are aware of the recent protests that we are having in US because of discrimination. But we will look at 2 other interesting aspects. One is product safety, and the second is the data security. In terms of product safety, Kobe Steel in 2017, it's a Japanese company, revealed that they had falsified data about the quality of its products. And these products were being used in automobiles and the bullet train. So nearly every person or every citizen of Japan was either riding in a train or driving a car that was built with products that were faulty in terms of quality. Equifax lost personal information, and this is not more than a couple of years old, right? 2018, Equifax lost personal information of 143 million Americans by failing to fix a known system vulnerability. What is interesting about this? The interesting part is 50% of the American population's data is available in the dark web. And when we have credit data, it basically has everything from social security numbers to purchase history to credit card details to what have you. And second, the vulnerability was known, but it was short-term profits that prevented rapid fixing of the vulnerability. Last year, we had 2 air crashes, Ethiopian and Lion Air. The 737 MAX, the photo on the left actually shows you the Boeing parking lot where all the 737 MAXs were grounded. 346 people died in those 2 crashes. And what was interesting was that all the investigation led to several system and manufacturing defects, including the way the pilot manual was written. And All this was known, but the product was still rushed to the market because of short-term profit requirements. In terms of governance, we all know of the Enron burst. $64 billion of assets is what Enron had. And its stock price was $91 before it fell to $1, and then it filed for bankruptcy. And Enron is what caused the US to suddenly realize that executives are not responsible for the disclosure. And then there was Sarbanes-Oxley and the certification of disclosure by executives. The second one happened around the same time. And what is interesting about the second one is where the auditor who was in charge of auditing Enron files and the data that went into the financial statements themselves were found guilty of crimes. And there was the famous shredding episode where overnight Arthur Andersen shredded all the files and ensured that regulators don't have access to information that can prove that Arthur Andersen was culpable. So this is the question of who will police the policemen, where Arthur Andersen itself had governance issue, and Arthur Andersen as an organization had to voluntarily give up their CPA license and could not practice in the US. We all know about the Lehman triggered financial crisis. So Lehman, who the fourth largest investment bank, had invested their funds heavily in subprime securities. And then when the subprime securities, or rather when the subprime creditors were given easy access to funds, it fueled a real estate bubble. And the rest of it is history, right? The world still has not recovered entirely from the 2009 or 2008 financial crisis. And we will see what is the impact of this failure in governance. So what we have seen here is globally there are enough examples where despite there being strong regulations, ESG compliance has not really been stellar. Is it different in India? Not really. So the world's largest man-made disaster, if you actually start looking at all the man-made disasters in the world, even today, the Bhopal gas tragedy is counted as the worst environmental disaster in the world. We all know where it happened. There were more than 500,000 injuries. So 5 million injuries and counting. There are other cases where we have environmental disasters. One was the fire that we had in Calcutta, 220 deaths. We had a recent leak in Vizag where 11 people were killed instantly. This was the LG polymer gas leak. And again, all these three cases, safety norms that government has stipulated in terms of environment were not followed. In terms of social, I don't know how many of us remember, but there was this Speak Asia scam that unfolded in 2011. Speak Asia was a company that came out of nowhere, took subscriptions for 11K and promised subscribers that they will earn 52K for filing survey forms, which never materialized, right? So everybody signed up, the company made 2,000, or rather the promoters made 2,200 crores and overnight they disappeared. Sharda Chit Fund scam. Sharda Chit Fund scam is where a Ponzi scheme was run and small investors, and we can't even count the number of small investors because they had no records of how many people had made the investment. And we are talking of really micro businesses like the Kirana Walas, the Sabji Walas, making daily investments in Sharda, and $5 billion were defrauded because of the chit fund scam. In more recent memory, Karvi, who had the power of attorney from the depositors, pledged 2,300 crores of their shares and took loans from banks and NBFCs. Even now, the shareholders don't know if they're going to get the securities back because the banks are unwilling to release it. And the SEBI is unclear whether they should take the side of the bank who's already under financial stress or the investors because they acted in good faith. In terms of governance failures, we know about Satyam, that was India's largest corporate scam. 2009, 14,000 crore company suddenly said that all the revenue that they were reporting were really on paper and most of it may not be true. Then more recently in 2018, we know that Chanda Kochar stepped down from ICICI Bank because of alleged corruption in sanctioning loans to Videocon, which had already defaulted in prior loans. So that's a funny case where the CEO personally intervened and said sanction loans when the evaluation team was saying that, sorry, we already have bad debt on our books from Videocon. And then ILFS, we all know, 90,000 crores of hole is what ILFS created. And the funny part about ILFS is that they did create a large portion of the assets, or large portion of the amount that they mobilized went into creation of assets. It was really an asset liability mismatch in terms of duration. But the funny thing, as I said, is that because the asset creation was happening on one side, the executives felt that they had done their job responsibly. And a fair amount of debt was also used to pay managerial remuneration and dividends to the holding companies. So what we are seeing in section 3 is that while governments have implemented a number of laws, and while businesses via starting of always express their commitment to follow these laws, when we really look at the world around us, we know that the laws are not effective and the compliance is more on paper than in spirit. In section 4, we see the cost of the mistakes, right? We know that mistakes have been made. We know that the ESG compliances have not been good. So what have the companies paid as cost? Let's look at the same example. The day the Volkswagen emission saga broke, right here we see that the stock price dropped. Sorry, I see that the slide is not refreshed. I'm wondering why. Sir, am I audible? Is it just the slide that is not changing, or have I ceased?
You are audible. You are audible.
Okay.
In which chapter name?
Funnily enough, the slide is stuck. I think.
Share again.
Yeah, that's what I've done. So it should come back. Hold on. I'll try and share all over again.
Must be a problem with your network speed.
Yeah, it's come back. So, in terms of cost of mistakes, it's been quite heavy. Organizations that have not been ESG compliant have had a sound beating. And most of the time, after the beating, the organization has never really recovered their past glory. Let's start with Volkswagen. The day the emission scandal broke, stock price crashed. And you can look up the stock price now. It has never recovered. And it's even the pre-pandemic price that I'm talking about. I'm not even referring to the post-pandemic price. Equifax. Equifax was tracking the S&P 500 till October when the scandal broke. And once the scandal broke in October, the stock price crashed by about 30%. You can look it up now. It has not recovered. British Petroleum. The day the oil spill happened, it just collapsed in terms of market cap. Look it up now. The oil sector itself has not recovered, but it is never going to go back to the days, the valuation prior to the Deepwater Horizon crisis. Boeing. The day of the crash, we know what happened in terms of stock price. It's not gone back. ICICI Bank. Again, it is gone back because of the swift action. It was just the CEO change. But what we see was a stock that was outperforming the Sensex. Yeah, till the scandal broke, suddenly started underperforming the Sensex. And it was almost rated as a public sector enterprise in terms of its governance standard. So you actually see that the valuation or the performance of ICICI versus the index had almost dropped to the SPI level. In terms of what happened in the too big to fail companies collapsing, we all know. $30 billion of federal guarantee, $150 billion of bonds that had to be issued by the treasury, so on and so forth. And at that point in time, the employment of the job losses that the market faced, only 40% of the jobs came back. the rest of the employees really did not get their full-time jobs back. So we know that as a governance failure in the US. Okay, so there is a cost for being poorly ESG compliant. But is the reverse true? Are organizations that are more compliant getting a premium from the market? The short answer again seems to be yes. So if you actually look at indexes published by numerous organizations, what you will see is the premium over the last 1 year for organizations that have shown themselves to be leaders in ESG compliance in the US has been upwards of 2.5%. In EM, including India and China, it has been upward of 3.5%. In Europe, where people seem to be valuing environment compliance a lot more, the premium goes up as much as 6%. And China, and we all know why China is important. Just selecting China, we see that the Chinese investors are giving 7.5% premium to organizations that have better ESG record or compliance. The same examples you will see here in terms of S&P 500 performance, return, and this is over a longer horizon. The above chart was 1 year. This is over 10 years. Actually 4 years. If you look at a 4-year performance, you will see that organizations who are in the top 20% in terms of ESG compliance actually get 11% greater or give 11% greater return than the rest of the index to investors. Investors have recognized that, and they are also now investing more actively in ESG focused organization. And the funds that are espousing ESG as a strategy are giving better returns than indexes. You will see all these funds here are doing much better than the S&P 500. And the index or the investment strategy of all these funds are to focus on organizations that have better ESG track record. And finally, it is also evident that bulk of the investment incrementally is going towards funds that have ESG as part of their investment strategy. Have organizations recognized this, and are they becoming more ESG conscious? Yes, and there is affirmative action that we are seeing. So a number of organizations have taken numerous initiatives. One among them is most of them have appointed what is now a new term called a Chief Sustainability Officer. And they are now focused on ensuring that the manufacturing is sustainable, the carbon footprint is reported, water usage is more or better managed, and there is a focus on renewable energy. In social responsibility, organizations are committing to equal opportunity, they're making human capital investments, they're ensuring that there is a financial product safety, there is improved data security, and responsible sourcing. So just a word on responsible sourcing. Anyone who's seen Blood Diamond as a movie will know what is the difference between responsible sourcing and sourcing at any cost. Governance, there is increasing board independence, there is transparency in executive compensation, there are greater controls to prevent fraud and corruption, and there are detailed financial guidance that most listed organizations are providing to the shareholders, ensuring that there is greater transparency between operations and financial numbers. And finally, disclosures are also going up. There is greater compliance with regulation, and any non-compliance is being reported to investors. There is progress on remediation. Most organizations that to remediate past failures are keeping investors informed on how they're progressing with the remediation. There is greater accounting and tax transparency. So organizations are now putting the numbers across with basis. And organizations are disclosing how their controls are working and whether they are effective or not. So that's pretty much what I had for the webinar. There are a number of topics. What I wanted to do was an overview and then leave enough time. Sorry, I'm a minute over what Professor Hariharan said I should take for questions.
Thank you so much, Ramnath. It's a brief and perspective on what ESG is and what the benefits we get out of ESG. We do have some good set of participants. There is one question which has come up from Surya Lakshmi. There's some opinion in India that non-compliance of laws can be managed. In the context of poor implementation, what is the incentive for firms to be ESG compliant? I think she is talking about not VUCA, but UCCA. Volatile, uncertain, complex, corrupt, and ambiguous. So in the UCCA world, how do we manage is what she's talking about. Yeah, Ramnath.
Absolutely. And this is, I think, the most pertinent question in most people's minds today. And the answer is simple. The answer is that we have now become global. The managed aspect typically pertains to what you can do locally. It is no longer what you can do globally. So the moment we have global investment flows, for example, take the case of Jio, right? Over the past 15 days, we all know how the lockdown went for Jio and who has cut checks that have come into Jio. Now, tomorrow when Jio is not as environmentally or socially conscious, especially with respect to data security and its social obligations, do you think that the US Congress is going to allow Facebook to get away with its investment in Jio? And what would Facebook pressure on Jio be? So what we are now seeing is, it's absolutely correct. The Indian enforcement has not evolved to the extent that we have seen in terms of global enforcement. But fortunately for us, two things have fundamentally changed. One, capital has become global. So it is no longer the case that the Indian investors are making investments in Indian companies. And second, the supply chains have become global. So anybody now to manufacturing and supplying to a Walmart can no longer employ child labor, because we all know, right, what happened when child labor was discovered in the Walmart factories supplying garments to, the factory supplying garments to Walmart in Bangladesh. Because of global capital flows and because of global trade, the obligations will be far stricter in terms of enforcement. And finally, when the new millennium or the millennials come into the investment era and start making investments, automatically the selection will be to organization, or preference will be to organizations that are more ESG compliant, and we will see that investment shift happen. So global capital, global supply chains, and changing preferences of millennials is what I am hoping is going to bring about the change, more than the law enforcement and courts that we see in India.
Okay. So second question, Vinod has asked this. Are there any companies giving sustainability index rating? And is it made mandatory in India for corporates?
There are a number of companies giving sustainability ratings. None of them are mandatory either in India or globally. So my earlier organizations used to give sustainable ratings. There is Sustain Analytics, there is Moody's Analytics, there is Standard & Poor's. All of them have now got into ESG assessments. They also do a benchmark and they publish it as ratings. But none of them have become mandatory so far. What they are used for is for investment selection.
Okay. See, Ramnath, extending the question further, in fact, if I look at, there is always a dilemma between ethics and law. I'm sure many of us use Apple iPhones. Am I correct?
Correct.
And the Apple iPhone purchases cobalt from Congo. In Congo, in the mines, they employ child labor. And incidentally, I think today is World Day Against Child Labor. Venkatesh is messaging that. So, and it is not illegal in Congo to have child labor. And what is the responsibility somebody like Apple has in this context?
Absolutely. So this is, as I said, the same case of blood diamonds, right? There are a number of these countries from where raw materials are sourced, where the sourcing itself is not extremely responsible. So what is happening increasingly is that investors are asking the question to organizations. Are organizations changing? Not on their own volition. Is the community forcing them to change? Absolutely. So if you remember the iPad Pro launch, Professor, do you know what was the duration of the seminar or the launch presentation? It was totally 2 hours. Do you know what was the time dedication to the product? It was actually 20 minutes. So out of 120 minutes, the iPad itself was showcased for 20 minutes. The iPad 2018 Pro. Do you know what Apple spent the rest of the 100 minutes talking about? They talked about how the components are recyclable. They talked about what society impact they're making. They talked about the collaboration. And they talked about how the Apple stores are environmentally sensitive, even though they're entirely glass. So what we are seeing is, yes, we will continue to see these odd cases of child labor getting employed, irresponsible sourcing, etc. But the pressure from the community will make sure that the organizations rapidly gravitate towards showing greater ownership on ESG factors.
Okay. There's another question. Do you feel limited participation of end users at the time of policy making? Reasons for non-participation of corporations wholeheartedly? Are end users involved in the formation of these things? Or is it predominantly consultants and policymakers?
Actually, the Indian context is different, or the emerging market context is completely different to the global context. Are the end users involved in legislations? Absolutely. But is the end user lobby strong enough? The answer is no. So if you look at the developed markets, typically the legislations are driven by the lobbies that have the maximum dollars. But there is a balance that is struck, because at the end of the day, the congressmen have to get the votes from the same population who need to be protected through the laws. So there is a greater balance in the developed parts of the world. In the emerging markets, typically what happens is there is a lot of legislation, but the entire business is driven by minimum compliance to the legislation, because profitability today does not come by being socially responsible. That is changing. But today, the scenario remains that emerging market, the user say is quite limited.
Okay. And you have to face this question. Baiju has a question. Ramnath.
Yes, I'm here.
Yes, okay. Given that the decisions are taken by executives and share prices of a company is decided by the investors or maybe brokers, take the case of BP. If at all any executive suffered, that would be marginal. So can ESG be enforced in such a scenario?
Actually, the executive suffering is marginal may not be true. Right? Let's take the case of Enron. What happened immediately? They prosecuted and put Kenley in the jail, and the poor guy died in jail. Right? BP CEO lost his job. The Volkswagen CEO lost their job. We all know what happened with a number of other cases. Chanda Kochar, we know what happened to Ravi Narayan. We know what happened to Harishankar. So in all cases, the executives really don't get away scot-free. And we are not looking at developed countries. I'm saying globally, executives don't get away scot-free. The second large part of the executive compensation is also stock price. So it is incorrect to say that if the stock price crashes, the executives will sit on their wealth. They don't. But is that enough penalty? In my view, the answer is no. Do they get away scot-free? Again, the answer is no.
Okay. So we have Anil Kumar from Power Plant. Anil, do you have any questions specifically? Because I remember you telling me that in spite of not required by law to have a limited pollution control, your company increased the auxiliary consumption by going for that filtering also.
Yes, Harihan. Thanks for giving me the chance to speak. Actually, I saw in the slides also the CLP's name was there. The slides was presented. Mr. Ramnath, yeah. So CLP has been, because we have our group headquarters in Hong Kong. So our environment and sustainability objectives and practices are global in the sense. I mean, we were ahead of Indian regulations when we set up the Jhajjar power plant. The flue gas desulfurization system was not required by Indian laws, but our Hong Kong shareholders insisted that we go in for that. And we invested around 300 crores additional at that point to install the FGD. Now, it was a good decision in hindsight because now it has become mandatory, and had we not gone in for that system, it was nearly impossible for us to install it now because of the tight configuration, space constraints the Chinese design has. So I have seen that such approach and strategy always works, though in the short term it may look like it's not going to benefit us, but ultimately it does. And in terms of governance also, CLP, I can say from my company, it's very ethically driven, and the only reason why a person can be fired is because of any corruption issues, and that too of a single rupee also. So, and CLP has created its name is known for this culture in government circles also. So initially it was a problem for us to get our files through, but later on it became an advantage because they knew that in any case we have to clear the files. So I completely agree with Mr. Ramnath's, or this is a standard in emerging practice now, that being transparent and ethical does pay in the long run, and we have to take care of the community. Now in the COVID era, we all know how everybody is affected by something happening in one corner of the world. So we are all connected now. So we have to take care of this planet collectively.
Thanks, Anil. Thank you so much. In fact, Ramnath, I distinctly remember in late 80s, they introduced ESP as mandatory in cement plants. It was not mandatory earlier. Electrostatic precipitator. But cement companies are reluctant to do that. But actually it turned out to be beneficial for them in terms of yield improvement.
True that.
Yeah,
and I have 20 other examples where initially there is a fair amount of pushback by the industry. And subsequently, when they realize after adoption what are the benefits, they go ahead and champion and ensure that the society per se benefits. I think Vinod has a question. I don't know how much time.
Are there any, we'll take another 5 minutes. Are there any mathematical models being developed and accepted to measure ESG costs of compliance? Maybe you can extend it further to economic rate of return and...
So cost of compliance, there are not too many models that I have seen, but the extent of compliance, there are a number of mathematical models. So how much are the companies complying on different parameters? There are mathematical models. What is the impact of inadequate compliance? There are mathematical models. For example, I don't know how many of us have heard about the 2-degree alignment. So what the Paris Accord said is, if the world temperature does not decrease by 2 degrees, or rather if we maintain the carbon emissions or greenhouse gas emissions, the world temperature will go up by 2 degrees. And if that happens, it will be a natural disaster of unmitigable proportions. So there was a Paris Climate Accord which said that we have to collectively reduce the temperature increase by 2 degrees. And for that, they had forecast models on what will happen if the same trend continues, what changes need to be made, which sectors have to contribute by what extent, and so on. So there are evolved models for these areas, but the cost of compliance, I think, is more specific to businesses within industries.
Okay, thanks. Maybe we can take one more. Let me ask Subramanian from across Atlantic. Okay, because there the compliance requirements are definitely more stringent, I believe, Subbu. Yes, Subbu.
Can you hear me?
Yeah, we can hear you.
Thank you. Wonderful presentation. My only, more than a question, a comment is, my organization happens to be following this, and we are a member of the UNPRI. One value that is not talked about, two things actually. One is, when you implement it, some of the benefits that come through your employees by being in a feel-good moment of it. That's very helpful. That's something you may want to talk about when you talk about this going forward, because there is some inherent value that you get out of it, right? And two, for a corporate, it's a free publicity. Because once you talk about it, people are aware of your product, more aware of you, something to consider. And one thing we do in our organization is when we select a vendor, we find out what is their corporate rules and responsibilities, and that is one of the deciding factor, not just the price when we select a vendor. Thanks.
Thank you so much.
Yes, Ramnath.
No, I said that's very heartening to hear in terms of how corporates are moving the needle.
Okay. I think we can wind up the session with this note. Thank you so much, Ramnath, for opening up on this particular topic, which is the way forward for many organizations. Maybe some companies are more evolved, like Anil said or Subbu said. There are some companies who are yet to move towards that.
Thank you
so much. Thank you so much, Ramnath, for this presentation. And maybe, guys, you can give a feedback quickly in the chat box, and then we can wind up the session. Thank you so much.